A YouTuber just dropped a $20 million stock portfolio update. That YouTuber is Meet Kevin, and today we're going to rate his portfolio update out of 10 by how well he can calculate and communicate his performance.
That's the messy thing about trying to, like, people are like, Kevin, what was your return last year? I'm like, I have absolutely no freaking idea.
All right, that's a video. Call it a wrap, guys. See you next time. Good job. All right, but let's wait a second. Just because he doesn't know his performance doesn't mean we can't calculate it if he gives us enough information. So let's start him at a 9 this time instead of a 10 and try again with some Tom Nash level investigation work. So here's a list of things we need in order to know his actual performance. And fans of the channel know that it usually doesn't go as planned. However, we're going to have a lot of fun playing devil's advocate today, especially because Meet Kevin's numbers are very, very large. So let's start off at the first few, which is start date and start balance.
On December 20th, 2019, I made a video showing you my $656-ish thousand stock market portfolio.
So the start date was actually correct. However, the beginning balance was actually $674,066.32, which I got from his previous video. And although that's annoying, I'm not going to dock him any points because he did give us the information. So then moving on to the end date, we're going to use January 9th, 2021, which is when he made that video, the most recent one. For the ending balance though, it's going to require a little bit of work. We're going to have to take that $20.5 million that he says is his ending balance, subtract the $4.5 million that's debt, and we're left with $16,098,808.55 as the ending balance. But just when we thought we were doing good, we got to the infamous transaction history. Transaction history. Okay, so I get it. I'm starting to sound like a broken record here. But it is something I see as the most common issue with investing YouTubers. And unfortunately, Meet Kevin is no different. I can't wait for you to hear this. Just listen to what Kevin gives us as the transaction history.
My guess, if I had to guess, is I probably put about $6 or $7 million in, is my guess.
Don't we all long for the day where we feel like we can be off by $1 million? However, with that said, he's going down to an 8 and then to a 7, and that's because there's a slim chance you might be able to get the rest of the numbers if you pay for a $629 course. But why would anyone pay for the $629 course if we don't know his return? Wouldn't it make more sense to first know his return and then pay for the course so we can have his strategies? It just seems kind of backwards to me. So the closest we get to transaction history is $6 or $7 million within the study period. We don't know how much and when each contribution was made, which gives us a really fun activity to do. We're going to play devil's advocate, and we're going to find out what spread of returns that leaves us if we try to make our guesses. In the best case scenario, we'll take $6 million instead of $7 million, because that means his investment return would have to make up the other $1 million. We'd also take that $6 million and assume he invested all of it on January 9th, 2021, which means the original almost $700,000 would be what compounded to get to the $20 million balance plus the $6 million contribution and then minus the $4 million in debt. Under this scenario, he would have 10x'd his portfolio. That means that is the highest return he could have made. On the inverse side, in the worst case scenario, we'll take $7 million instead, and we'll put it at the very beginning, meaning that there's less to compound. Under this scenario, he 1x'd his portfolio. That is a massive and tremendous spread. He could have a performance anywhere between 1x and 10x given the information. Now hold on, because I can hear people screaming through the device that I'm being too unreasonable, and I get that. However, I highly recommend that this next part, we don't take it as more realistic. However, we're going to do it anyway just because a lot of people have been telling me it's really fun to see what a difference these numbers make. And that is, we're going to assume Kevin told us that he puts in contributions the first of every month. However, we still don't know whether it's $6 million or $7 million in total. We just know there are equal contributions throughout. What kind of difference would that look like? With the $6 million spread evenly on the first of the month, his return annualized would be 280%, roughly. And with the $7 million, it'd be close to 220%. That is a 60% difference. That is phenomenal. Said another way, that means our assumptions could be off by as much as 25%. That's too much. Okay, so I wrote out this next part saying that if I had to guess, I would probably assume he outperformed the market. However, there is actually a possibility he underperformed. But then I kept thinking about it, and then I said to myself, well, we didn't even count for free stocks that he got across all his platforms. So right now, the way the math is, a $5 free stock that he got looks like $5 in investment gain. And without extracting any of that information, we don't know what that looks like in terms of his actual performance. Add to that, how durable do you think his performance is, even if he is outperforming, if he doesn't know how to calculate his return and say definitively whether he's outperforming or not? This can lead to a pernicious situation where he might think that he's outperforming the market when he's actually not. So he might be doing things that he thinks is outperforming when he's actually not. All said and done, I would not invest like Meet Kevin. Or, I should say not yet. And that's because Meet Kevin is one of those rare exceptional people who would actually give a video like this the time of day. In fact, he's probably in the pursuit of it. That's the kind of character he is, and the reason why he's one of my favorite YouTubers. Now, even though his investing stock portfolio journey didn't actually tell us what his return was, it did give us a good look at his entrepreneurial prowess. Anybody that can turn almost $700,000 into $20 million in 1 year is definitely onto something remarkable. However, let's show him how easy it is to calculate and communicate the performance. Because if we can help him, it's going to help us determine if his investing strategies are going to help us make more money, right? I don't think I've ever laid it out this simple before, so I'm super excited. A lot of times because Excel isn't exciting, despite how similar the words sound, it makes it really hard to talk about this. But I think I got it. I think I got it real good. So here it is. All Kevin would need to do is create an Excel sheet that looks just like this one. On the left-hand side, you would have the date from the start and the end whenever you want to do the period. So let's pretend you wanted to do January 9th, 2021 to January 21st, 2021. Those are the dates. And on the right side, you would just have the transaction history. Now, the formula we're going to use is called the XIRR formula at 4.31%. To do this, you actually have to do something a little counterintuitive. The beginning balance, that 16 million that he talked about before, is going to go in as a negative, and the ending balance is going to come out as a positive. So you can see that on the bottom. All the contributions are going to be negative numbers, and all the withdrawals are positive numbers. And if that doesn't make any sense, that's okay. Just take my word for it. That's the way the formula works. And then you kind of want to adjust for free stocks. Now, each person can do this differently. Meet Kevin probably gets a lot of free stocks, and he doesn't want to probably take out consideration for free stocks because it really has nothing to do with your performance. It's not like you had a choice where the free stocks went, right? However, Meet Kevin's strategy might be to keep the stock. So in his instance, I probably think it's best just to pretend like if you got a $5 free stock, pretend like you put in $5 and then he can decide what he wants to do from it there. That's probably the best way to look at his performance. However, the best thing you can do is just give everyone all the information they need and they can decide for themselves. But at the very end, you have this positive sum, that's your ending balance. I also did an example where if you had a $1 free stock, what would that look like? And in this instance, your return is 14.31%. There it is. Super easy. Probably another thing I can think of too is when you think about money going into or out of the portfolio, don't think of it in terms of like you bought a stock, sold a stock, or you went from cash to stocks. Think of it instead like if this is his portfolio, and Meet Kevin actually has many portfolios in his asset allocation, we'll call it. You just want to consider money that went in or money that came out. You don't care what happens inside the box, just when it came in or when it came out and by how much. So that is how you calculate the performance. And if that confused anybody, I apologize. I'll talk about it a million times. Feel free to ask me questions in the comments. But that's it for this video. If you found the content helpful, make sure you like that smash button by stalking our subscriber count and Liberty Bell that notification icon. As a last note, my good friend Adam Mead at the Oracle's Classroom on YouTube is putting out a wonderful series about accounting that you must check out. So make sure to go right there right after this video. But that's all. Thanks for watching. Until next time. Oh wait, but there's still that 6 in the corner, isn't there? Don't you think I forgot about the lightning round now? No tax considerations, no considerations for benchmarks, and then there's this one.
I use spreadsheets in a very simplified way. Because spreadsheets can get overly complicated. Like oftentimes I'll see other YouTubers and they're like, look at my discounted cash flow formula. And like, nobody knows what you're talking about.
This one's personal. Down to a 3.
All assets decline in value when prices go up. The value of an asset is the discounted present value of the future cash flows.
But the real question is, Berkshire selling for, we'll say, 105 or so billion now. What can we distribute from that 100? If you're going to buy the whole company for 105 billion now, can we distribute enough cash to you soon enough to make it sensible at present interest rates to lay out that cash now? And that's what it gets down to. And if you can't answer that question, you can't buy the stock. You can gamble in the stock if you want to, or your neighbors can buy it. But if you don't answer that question, and I can't answer that for internet companies, for example. There are a lot of companies, there are all kinds of companies I can't answer it for, but I just stay away from those. Number 2.
So you got formulas involved in finding intrinsic values on certain companies. I mean, you've got a mathematical system set up.
Discounted present value of future cash, yeah.